Welcome to the Explainer. Today, we're diving into a really fascinating text called The Digital Ledger: Sovereignty in the Age of Programmable Money. We're going to objectively unpack the author's deep dive into a massive financial shift that's happening right now: the rapid global transition towards central bank digital currencies, or CBDCs for short. Let's map out exactly what the author's arguing about the future of, well, our money. Right off the bat, this source text draws a hard line in the sand: the year 2026. The author is predicting a massive, synchronized global surge in retail CBDCs by that date. But here's the real kicker: they say it's going to pair with the rapid decommissioning of traditional ATMs. Just imagine going to your local ATM to grab some cash, only to find a permanent out-of-service sign. According to the text, this isn't an accident. It's part of a systematic plan to phase out physical cash entirely. To make sense of all this, we're going to break down the author's four core themes. 1. The end of physical cash. 2. Programmable money and control. 3. The new inflation mechanics. And 4. Building a financial fortress. Okay, let's jump right into section 1, the end of physical cash, and what the author sees as a fundamental shift in our property rights. The author draws a super stark contrast between the money we know today and the money that's supposedly coming. Traditional physical cash offers complete transactional anonymity. When you hand over a crisp $20 bill, it leaves literally zero digital footprint. It's permissionless. Cash is king, right? But programmable money? The text argues this is the foundation for absolute financial surveillance and fully traceable property rights. The author points out that this loss of anonymity isn't some sort of glitch in the system. It's actually the whole point. It's a fundamental transformation that turns our private, everyday transactions into fully traceable data points. Which brings us perfectly to Section 2, Programmable Money and Control, where we look at the actual architecture. So, how is this new system actually built? The author outlines an architecture of digital control that honestly goes way beyond a simple digital wallet app on your phone. Because these CBDCs operate on centralized ledgers, the text argues they can be directly linked to individual social credit systems or even carbon footprint tracking. Think about that. If your purchases push you over a certain carbon allowance, the ledger knows instantly. On top of that, the source highlights that this architecture allows central banks to enforce negative interest rates directly. Instead of just lowering abstract policy rates, the bank could theoretically deduct a percentage right out of your digital savings, automatically, without your consent, just to force you to spend it. Crazy, right? The key mechanism making all this possible is something called smart contracts. The text explains these are essentially pieces of self-executing code. Imagine a store gift card that automatically expires if you don't use it by a certain date. We've all had those, right? Well, the author warns that this exact same logic could be applied directly to your life savings. This gives centralized institutions programmable control to just automatically freeze funds or enforce expiration dates on your money. So, programmable money literally means money programmed to behave in ways that benefit the issuer, not necessarily you, the holder. Moving right along to Section 3, the new inflation mechanics and the idea of surgical monetary policy. Let's talk about quantitative easing, or QE. Traditionally, central banks inject money into the financial system, and it kind of slowly trickles down into the broader economy over time. It's a blunt, slow-moving instrument. But the author explains that CBDCs change the game completely by allowing for instant liquidity injection. Since everyone would have a digital wallet hooked up straight to the central bank, money could be beamed directly to consumers in an instant. Now, I know that might sound super convenient, but the text argues this actually accelerates currency debasement way faster than traditional QE. It enables what they call surgical monetary policy, meaning the central bank could devalue the currency of very specific demographics or business sectors in real time. It completely reshapes who bears the economic burden. Building on that surgical control, the text identifies a major risk that they term velocity mandates. Now, the velocity of money is basically just how fast dollars move through the economy. So, say the economy slows down in 2026. Under this new system, the government might not just encourage you to spend, they could literally force you to. A velocity mandate means the government could program a chunk of your money to just disappear if you don't spend it fast enough. It artificially stimulates the economy by essentially slapping a ticking countdown clock on your purchasing power. It is a massive departure from the old save for a rainy day mindset we all grew up with. So, with all that alarming analysis about programmable money and hidden inflation taxes, you're probably wondering, how does the source recommend actually protecting your assets? Well, here's the roadmap they lay out. Let's dive into Section 4, Building a Financial Fortress. The absolute core of the author's defensive strategy relies on a concept called outside money. The text advises moving beyond traditional banking entirely and reallocating your wealth into assets that exist completely independently of this global unified ledger. What does that mean? Well, the primary examples they cite are physical gold and self-custodied Bitcoin. The argument here is that by moving assets off the central bank's programmable rails and into outside money, you effectively escape the reach of those velocity mandates, negative interest rates, and automated account freezes. You're taking your chips off their table. The text builds this into a broader strategy they call strategic diversification protocols. To keep your transactional privacy intact, the source recommends using decentralized finance, or DeFi, protocols that run on non-governmental rails. This makes sure your transactions aren't just feeding straight into a central surveillance database. Also, the text brings up a really interesting concept called jurisdictional arbitrage. This basically means intentionally holding assets or setting up financial footholds in regions or countries that are actively resisting the adoption of a global unified ledger. It's all about spreading your risk out across totally different legal realities. Finally, the author gives us a practical day-to-day guide for actually building this fortress, broken down into 3 steps. Step 1, build a multi-tier emergency fund that strictly prioritizes high intrinsic value physical assets over digital promises. Because let's face it, if the power grid goes down, your digital balance is absolutely meaningless. Step 2, get some offline payment methods set up. We're talking barter goods, precious metals, or even good old-fashioned analog ledgers. And step 3, which honestly sounds a little bit like digital doomsday prep, is to establish private mesh networks. The text actually suggests preparing for potential digital bank holidays or blackouts by having independent communication and transaction networks that don't rely on the standard state-monitored internet at all. As the source text wraps up its analysis, it challenges the reader with a pretty heavy question. Because, protecting your assets isn't just about what you spend today, it's about the legacy you leave tomorrow. So the text asks, in a fully digitized world governed by programmable ledgers, how will you ensure your generational wealth remains sovereign and unfreezable? Truly something to think about.